Canadian Pension Plan. One of the benefits you get when you retire in Canada after working 40 years is CPP, Canadian Pension Plan. In this video, we're going to talk about how much you're going to get in terms of Canadian Pension Plan, who needs to contribute to it, how much you contribute to it, and what happens if you take it earlier or later, and what are some of the resources that are available to help you figure this out as well. Let's get started. The Canadian Pension Plan is designed for working people above 18, and you need to contribute a percentage of your income to CPP, Canadian Pension Plan. Now, this is based on a percentage of your earnings and is typically around 5.54%. And usually your employer will pay half and you pay half yourself. The maximum contribution per year, if you want to contribute more, is $64,900 in 2022, and this number increases year over year. Now, the CPP provides monthly income to you when you retire if you have contributed during your working years. So when can you get CPP? You can get CPP as early as 60 and as late as 70, and the standard age is around 65. And delaying getting the CPP will actually give you more CPP. I'll give you the calculation as well. How much can you get? I'm going to include the link to the CPP calculator down below, so you can refer to it after this video. Now, for example, you're 60 years old right now, born in 1960, with $60,000 per year as your income. If you retire at 63, which is what the calculator allows you to retire at, you get $5,500 per year. If you wait until you're 70 and get your CPP, then you're gonna get $12,000 per year. So approximately $1,000 a month. So if you look at the difference, if you're willing to wait 7 years, you can actually get double the amount of CPP from the government. Now, the risk here is really your life expectancy. Let's say it's 85 years old. Delaying getting your CPP may reduce the amount of benefits you get if your end life is either earlier. Here's another example. Age 60, born in 1960. And you earn $90,000 per year, so a little bit higher income. If you retire at 63, you get $7,000 per year. If you retire at 70, you still get $12,000 per year. Now, what's interesting is that I have increased the income by 50%, but then the ceiling of your CPP at 70 is still $12,000. So later on, I went back to the calculator and I tried to enter $150,000 as the yearly income, and even at 70, the maximum CPP you can get per year is still $12,000 per year at 70. So there is that ceiling, so there is that cap. So once you make more money, then you're not really getting much more benefit from CPP since it's capped at $1,000 a month. So one of the interesting thing is the survivor benefit of CPP. Now, if the CPP contributor ends up dying early, the spouse or the common law partner can continue to receive the benefit, and additional benefits are available for the dependent children as well. Now, getting CPP is not automatic, and you actually need to apply for it. So I'm gonna include the link down here so you can click on it and apply for it when the time comes. If you want to know how much you contributed or where you're at with your contributions, you can actually visit the website CRA here and get a copy of your statement of contributions. So I'll include the link here as well. So that is pretty much all you need to know for CPP. And I really think the key takeaway here is it doesn't scale with your income. Once you make over 60,000, you make 90,000, 150,000, you're just getting a maximum 1,000 a month of CPP from 70 onwards. So at some point, you might wonder to yourself that, hey, if the maximum I can get is 1,000 per year at 70, I might as well just get it a little bit earlier, let's say 63 or 65. And if I can get 7,000, 8,000, it actually might be worth it to enjoy more CPP during your earlier years for retirement. So that's CPP for you. Let's be honest here. With inflation, going up so much, I think last 2 years, 10%, and this year's 3%. And obviously, we're not gonna imagine ourselves in a deflationary environment. Just getting 1,000 a month is probably not enough to retire. 1,000 a month, in Vancouver, you couldn't even pay rent. Like a 1 bedroom in Vancouver nowadays is like 1,500, and that's just today. And in the model that the CRA provided, the CPP figure is 10 years from now. So 10 years from now, you get 1,000 a month. That's more gonna feel like $600-700 a month. So that means in order for someone to successfully retire, you actually need a combination of TFSA, any additional pension, a lock-in pension on top of CPP for you to have a successful retirement. And of course, if you have any additional strategies that can generate income with minimal work using the capital you have, then I think that's obviously a plus. When you're thinking about retirement, you actually need to take into all these factors into account, because just CPP alone wouldn't be sufficient. It's very clear that with the amount of inflation and immigration coming into Canada, you need some sort of investment, something that would appreciate along with the GDP of Canada or the population of Canada. Obviously, housing is the number one thing that comes to mind. It's the most straightforward, almost no-brainer if you're living in a Toronto or Vancouver big city like that. With the amount of housing coming onto the market, it's actually not fast enough to catch up with the immigration and the population growth. So that's why we see a continuous increase in land value, a continuous increase in condos being built in Canada to address the housing issue. What you end up getting in the housing side of the market is you want to be buying a place as early as possible, holding on to it mortgage-free ideally so you can retire in it. Now, some people might take a loan out of that place and use it to invest to generate income, which I still think is fine. But what you'll see is that once you sell a place, let's say 2,000 square feet, and you downsize, then you wouldn't be able to catch up and buy that same level of space again, meaning that for Vancouver and Toronto, we're increasingly become a small space city. For example, like you get smaller condo, you get studios, like 400 square feet condos that previously no one would have imagined these kind of properties showing up in Vancouver and Toronto. But if you look at places like Tokyo, Hong Kong, Singapore, these are actually really common size of property. And with the amount of immigration coming into Canada, I don't think the housing costs will be reversing anytime soon. Looking at the amount of CPP and the inflation working against the CPP is not going to be sufficient for sure. Now, of course, if you look at the market, you may be able to take a little bit of risk, like investing in S&P 500. The average return is around 10% a year, minus inflation, 3%. You're still getting a decent 7% growth a year. Unless you employ a higher return strategy, then you're stuck just investing bulk of your money into S&P 500 with sufficient time, then you can retire with a decent amount of capital in your RRSP or your TFSA. Now, if you didn't get to do this 20 years ago, which was the ideal time to invest, and you only have 5 years remaining now, then you need to take more risk. Maybe it is a more advanced monthly passive income strategy. Maybe it is a small business you can run that can generate cash flow. And I think a lot of people will come to that realization soon, is that some people might need to take a part-time job during retirement, or you might need to do some, freelance consulting work, some gig work to supplement that income. And probably still need to do some kind of work unless they're able to generate more income on demand for themselves. And you need to use a more advanced strategy, and you need to be more creative in terms of how you can generate cash flow.